still building pyramids, and I'm still watching the markets, but I'm taking my vacation. So I'm back because there's a lot to talk about even in the midst of this vacation that I'm on, because literally look what happened in the stock market the past 2 months. I mean, kind of impressive, pretty bullish. It's basically everything that we've been looking for basically since June 16th, since we suspected that the bottom is in. So if we believe that the stock market is controlling the momentum of the crypto market, well, then we have a lot of reason to be optimistic about what's to come in the crypto market. But now we need to assess, is this a sustainable move in the stock market, or is this just what they call the bear market rally? Well, it looks pretty powerful to me. It looks like it's setting up a larger wave where this whole move right here is potentially just a wave one. Now, what do we know about waves? We know that each wave has waves within it. So let's just assess what we have on the chart so far in the Dow Jones Industrial Average. So we've got clear wave one, wave two, classic. We got that powerful wave three, classic. So we're either looking for wave three to pull back in a wave four right now, or wave three to just keep continuing, because no one expects that. And most people are probably thinking that this is the perfect moment to go short. Either way, let's just play it conservatively. Let's say that we're going to pull back in a wave four. Where could we expect that wave four to pull back to in the Dow Jones here? Well, if we look left, that's going to help us determine where there's support. We look left, we have one level of support, two levels of supports, three levels of supports right around this 33,000 level, right about here. Let's say just below 33,000 for a wave four. So let's say that's where our wave four pulls back to. Where do we think that wave five is going to complete? Well, probably our high probability reversal level, the 702, right? That would make infinite sense. And then we look left and we see, yep, there's definitely resistance here. We have to break through that resistance. So it would make sense to pause out right here. We see resistance, we see resistance, we see resistance. This is where the Dow Jones started to sort of look like it could be rolling over. So this 702, when we look left, is very relevant. It's extremely relevant based on the past. So what do we think? If this is a five-wave impulse off the bottom, well, now we're going to consider this entire five-wave move to be a wave one move, right? So then let's do the whole trick where we do the larger wave count, right? So we have five waves within a wave one potentially taking us all the way to this 702 right here. And then we have to get a wave two down. Now, this is where we could get a significant pullback. And it would make sense to see us pull back, if this is all a wave one, to potentially pull back as low as this level where the 236 is. If we look left, we see we have a lot of support around that 236 level. If this is the beginning of a five-wave impulse that could take us to higher highs in the stock market, give us that momentum we need in the crypto to get that retrace on Bitcoin, to bring us that altcoin season, this wave two could be very scary. Definitely could be very scary. And most people will be like, yep, told you, stock market's going to crash. Like, we're all going to hell. But really, what's it forming? An inverse head and shoulders pattern. That's what it would look like if we find support at the 236. And if we look left, back in history, oh yeah, looks like there's some solid support here at the 236 to set up that inverted head and shoulders pattern, which would be a massive, massive bottoming structure. And then that sets us up for a wave three. And look at this now. Now we're starting to see the makings of something pretty bullish that's going to take us to those all-time highs I've been talking about. And that's not where I would complete the wave five. How many times have I said wave five probably going to take us to that 1618? High probability of a reversal at the 1618. And if we do stay with this five-wave impulse move off the bottom, and this ends up being that inverted head and shoulders, well, the highest probability of a reversal would not come until we're way up here at the 1618. Realize volatility, everything comes in waves for sure. But this is the makings of a higher move, no doubt about it. Now, when we talk about the macro environment and we talk about the Fed policy and all the reasons we have to be scared, there's some nuance that we need to consider in this situation where we're in these raising interest rates, we're in that tightening fiscal policy. You know, we're getting fed a narrative that we should be scared, that we should be bearish on the markets. But here's what I would consider. I would consider that the Federal Reserve, to a certain extent, has lost control of their ability to, quote unquote, cool off demand by raising interest rates. Now, why could that be? Well, this is where inversion theory comes in strong once again. So, inversion theory on a basic level tells us when there's fear, you buy. When there's greed, you sell, right? But what we should consider is how the actual narratives that we're being fed are inverted. And the fundamental case has something to do with the fact that 1% of market participants hold 99% of the capital. I'll repeat that. 1% of market participants hold 99% of the capital. This is why, since 1994, we have seen a positive correlation with interest rates in up cycles and markets in up cycles. This is because if 1% of market participants hold 99% of the capital, that means that the 1% of those market participants are extremely wealthy, right? As the wealth gap increases, as the richer get rich, the poorer get poorer, and the middle class is just eliminated progressively, that is why interest rates rising have a positive correlation with markets. This is because rising interest rates, an increase in the cost to borrow, does not affect the super wealthy. It does not affect that 1%. They don't care what the cost to borrow is. You know why? Because they're liquid. They own real estate. They own assets they can leverage for more liquidity. They can take equity against their properties. This is why we need to reconsider the idea that raising interest rates can cool off demand. And we actually need to consider the idea that the Federal Reserve does not have control over the economy in the way that they used to. And the obvious evidence right on the surface for that is that literally when interest rates began rising, the stock market began rising. Do you understand this? So this big sell-off we saw in the Dow Jones and the stock market, this sell-off was anticipating rising interest rates. But really, the interest rates rising sparked this rally that we see here. That plays into inversion theory in the basic sense that there was a lot of fear in the markets down here, but the large market participants just saw opportunity. And what have we talked about on this channel since day one? We've talked about we follow the whales. That is why we are not fearful when the majority is fearful, because we see the same opportunities that the whales see. So yes, theoretically for you and me, if the cost to borrow is higher, that limits our ability to participate in markets. Yes, that is true. That makes it more difficult for the middle class to make money on these types of moves. They cannot borrow money like they were previously. However, if you have the capital and you have some job and you are earning any money at all at this time, you're not borrowing it, you're just earning it, and you're following the whales, then you don't need to worry about interest rates rising. All you need to concern yourself with is the question of, are the whales buying? And the Dow Jones tells us they certainly are. It tells us that they certainly are. So if we see whales purchasing and moving the market higher. And at the same time, we're getting this narrative that interest rates are rising, markets are going to cool off. Well, we should consider that interest rates rising aren't going to cool off markets in the same way that the Federal Reserve expects them to. So fortunately for us, inflation works in the markets just like it works on the cost of gas and the cost of food, right? If there's a lot of liquidity in the system, there's a lot of dollars sloshing around in the system, the value of those dollars goes down and the value of the assets goes up. This is why on a basic level, we've really been bullish the entire time. Assets are more valuable than dollars at this time. Now, that makes us need to consider what the DXY is doing because it just keeps going higher. Now, should we be worried that it keeps going higher? No, we should play the probabilities in our favor. The higher this thing goes, the less likely it is to continue to go higher. In the same way that the lower the stock market goes, the lower cryptocurrency goes, the less likely it is to continue to go lower. Now, at some point, we don't know when that is, but at some point, we're going to get a reversal in the DXY. That's because fundamentally, the value of the US dollar is going to lose strength against assets. Why? Because there's just increasing amounts of money printing, increasing amounts of liquidity getting pumped in the system. I mean, what's going on politically speaking? We're trying to fight inflation by printing more money. Literally, that's what's going on. The current administration is going to fight inflation by printing more money. This is where the basic kindergarten logic kicks in. If you have an influx of liquidity, doesn't matter what the reason is. If we are about to start another cycle of money printing under the reasoning of it's going to fight inflation, which obviously makes no sense, but let's just say whatever the reason is, if we're going to start to see increased liquidity in the system because of this new initiative that we're going to use to quote unquote fight inflation, well, guess what? This is another strike against the dollar reaching higher. The dollar will not continue to rise if money is printed. Now, at some point, we're going to see that reflected in the charts. We're going to see a reversal in the dollar, and we're going to see the Dow Jones continue to rip higher, setting us up for that upside we've been looking for in crypto for a long time. The pieces are coming together. The setup is taking shape. We're overextended in both sides. We're overextended on the dollar. We're overextended to the downside in cryptocurrency. And the evidence of that is simply just on the chart. It's simply just in the Dow Jones. Look what the Dow Jones has done. This tells you that we're not likely to keep moving to the downside in assets. This is fundamentally supported by the fact that whales, large money players, are buying. They bought this dip. They are putting the price higher because they saw the opportunity. We don't need to be fearful if we're following what the whales do. The whales are buying. We should be buying. We don't need to listen to the noise of the Federal Reserve and interest rates because we can clearly see that interest rates are not affecting the markets to the downside. They're fulfilling the same prophecy that we talked about when I first introduced the concept of inversion theory, which is that since 1994, we've seen a positive correlation between the federal funds rates and markets. Look at this, just to remind you, between 1993 and 2000, we saw the Fed fund rate increasing. This led to a blow-off top in the stock market. We had a massive dot-com boom right here as interest rates were increasing. And the final blast-off for those interest rates increasing was at the exact moment that the stock market had its final blast-off top. Same thing here, going into the 2008 financial crisis. You had interest rates rising from 2004 all the way to immediately before 2008. When 2008 occurred, it was actually after interest rates had started coming down, right? Positive correlation. Exact same thing we see it again here. Interest rates rising from 2015 all the way to the summer of 2019. What happened in the spring of 2020? We saw the stock market crash and interest rates came down before the stock market crashed, okay? Positive correlation between interest rates and the stock market. And then what do we see here? We see a very sharp rise in interest rates beginning. And what do we also see at the same time? A sharp rise in the stock market. Positive correlation. Inversion theory states that we're led to believe that the Fed funds rate has a negative correlation to the markets. But now we have the crystal clear evidence to support the exact opposite. The Fed funds rate increasing correlated to a rally in the Dow Jones in the wider stock market. Now, there is volatility that we should expect, but in general, inversion theory is playing out exactly like we expected it to ever since I started talking about it. Here we have the proof in the pudding right in front of our face. Now, how does that apply to the crypto market? Well, we've already talked about that the crypto market has been following the stock market in lockstep literally since March 2020. I mean, this is all just a variation on the theme of what the stock market is doing. Is it wise to expect that crypto finally broke away from the stock market? That's why it hasn't moved up yet? No, it's just a little late to the party, and it's giving us that opportunity to load up right now. So now if we want to zoom in and we want to talk about altcoins, well, we can see that some altcoins are really giving us that signal of like, yeah, we're ready to break out here. We're ready to break above that 236. We should be expecting other cryptos to follow in the same way that TRB has, the same way that Ethereum Classic has, breaking out of key levels here, breaking out of key levels of resistance, turning those levels of resistance and support, and also seeing moving averages curl to the upside, right? We're seeing that in the altcoin market. So what we've always talked about is that we expect altcoins to move with more velocity to the upside than Bitcoin does in this next phase. We're already seeing that. We're seeing examples like Bond, TRB, Ethereum Classic. But then at the same time, we're looking at the Bitcoin dominance just falling. It's just falling. It's in a massive downtrend. And of course, that supports the idea that Bitcoin may not reach a new all-time high in this next phase of the market. We can already see that Bitcoin is definitely lagging behind the stock market. It's lagging behind altcoins. And when we look at the Bitcoin dominance chart, we just see it's in a downtrend. So once again, the setup is taking shape just like we always expected it to. And the fundamental argument is that the Fed funds rate going up is giving us that signal that we're in the end phases of a money volcano here, just like we saw in the dot-com bubble in 2000, just like we saw right before the great financial crisis in 2008. Fed funds rates coming up, and then they start to go down right before the market turns down. We do not see the Fed funds rate turning down right now. Now, everyone else on YouTube, literally, I still think I'm one of the only people talking about this. Literally, go across YouTube. Everyone says, yep, nope, the Fed is going to keep raising rates. There's no reason to expect that markets are going to go higher. We should be at, 3% by the end of the year. Probably, exactly. And that's why we should expect markets to keep moving up. The way that I see it is I don't expect markets to turn down until we start to see the Fed funds rate roll over. That's what we saw in 2000. That's what we saw in 2008. That's what we saw in 2019, anticipating the crash that occurred in 2020. Literally inversion theory, literally everything we expected playing out exactly the way we expected it. And guess why I get to sleep really well at night? Because I'm the only one who realizes that there's a positive correlation between the Fed funds rate and the markets. And it's so blatantly obvious to see. It's right here in front of our face, right on the chart. Please link me a video that is somebody else talking about this, because if inversion theory is going to hold true, then we can rest assured knowing that we're going against the grain by seeing the basic factual evidence of history playing out like it's always played out for now almost 30 years. So sleep good at night and consider some of my favorite plays right now, some of my favorite plays that are setting up. Filecoin. File freaking coin, kid. Look at this thing. Yeah. Literally, like this is like a 30x to a very predictable retracement. And who knows if it's going to stop here? We don't know, but if we're looking at high probability levels and we look at the fact that certain cryptos have already broken above, just peeked their heads above that critical 236 level, look at Filecoin. It's like an 8x just to get to the 236. Hello, there's literally money to be made here, right? I mean, even in the most conservative outlook, there is money to be made here. Now, what's likely to happen in the immediate future? Probably a pullback. However, literally 99% of people are expecting a pullback. What does that mean? That you might not get a pullback. So it's just like, it's very inverted right now. Inversion theory is really the name of the game. That's the lens you need to use to look at these markets. You got to think in inversion theory. And that's what we're specializing here in the White Knuckle Report. So, all right. Now, don't forget, I will be back with Tool Tuesday, and it's going to be epic. All right. So just be patient. I'm just enjoying my vacation. I need a break here, okay? I need a freaking break. But it just excites me to get back into the music. Gas Station, that album is turning into a monster with a mind of its own. And I cannot wait to show you guys the new Gas Station Mentality album, Cyclical Antiquity. This thing is going to hit hard when it hits. Be patient. I'm giving you guys a preview of some of that with the intro music and outro music of today's video. And just remember, it's all inverted, okay? Do the opposite of what they tell you, okay? Literally, do the opposite of what they tell you. It's that simple, all right? Good!